So in this video, I'm going to be talking to you about why is it necessary to build a dream team, or is it really necessary to build a dream team in the Dan Pena's QLA model. So if you don't know about who Dan Pena is or what the QLA model is, Dan Pena is my mentor who I attended two of the seminars with, the QLA and the QLA Hardcore. It's a model of creating wealth through buying companies. So that's what we're talking about here. And there is a step in the model which is known as creating or building a dream team. So there is a lot of misconception about this step that you don't have to do it, and Dan Pena's model has gotten outdated, and you don't need to do this step. You don't need to build a team. After all, it's about just acquiring a company. Why can't you just acquire a company? It already has employees, so you can just go and acquire a company. What's stopping you? Why do you have to do this groundwork, and why is it necessary? This seems to be something that maybe was relevant during his time 40 years ago, and it's maybe no longer relevant. Well, that's not true. And I'm going to be talking to you about why exactly you absolutely should build a dream team, and how it's going to serve you, and how your odds of success is going to dramatically increase if you have a dream team. So it's an absolute step. Another thing that Dan talked about in the seminar is one of the causes of failures in this model is because people don't follow the steps. And the steps are as follows. You have to choose a region industry, create a vision of consolidating an industry, build the dream team, get the lawyers and accountants, go to the banks, and then look for deals. You don't go looking for deals directly. And this is a very big sticking point, is that people jump the gun and go straight to the deal, and there is catastrophic effect that happens. Speed is not the priority here. I see also going this, and sometimes it even came from him, that the most important thing for you to do is to do your first deal. Well, he's not talking about doing a bad deal, and he's not talking about skipping the steps. So I know of people who skipped the steps, acquired a company, and then the company went into loss. Well, how did a profitable company go into loss? Well, maybe that company wasn't profitable, and maybe nobody on his board, on this person's board, told him that, because he didn't have a board. Okay, so it's very important to understand that if everybody was just honest in business and put all their cards on the table and disclose all the information necessary, then you may not need a dream team. But that rarely happens. People are hiding information, people are withholding data, and you're making a decision on data. So I'm going to be talking to you about several examples that I have seen of deals and businesses that I came across, and I had a certain view about these businesses. Oh, what a great deal I found. And then when I presented it to my board, they gave their analysis, 30-year plus analysis, and then the whole picture changed. So we're going to talk about that also in the video, so make sure you watch it till the end. If you're new to the channel, hit that subscribe button, and let's get started. So here is the thing. This model is about buying companies, buying profitable companies. And before you buy a company, you have to value the company, and you have to do an evaluation of what the value of the company is and how much you're paying. So to do that, you have to analyze the company legally, financially, and from an operations standpoint. And you also have to look at their taxes. So you have to look at financially, legally, and operationally. And if you have not had experience doing that, and if you have not had experience looking at a financial statement and judging the health of the company, then how are you going to evaluate the company? I remember I was with a senior partner from PwC, who was a board member of mine, and I found a multi-million-dollar clinic, profitable, to that we could acquire, and the owner wanted to sell. I got the financials, everything was set, and then I took the financials to the PwC partner who has done this for 30 plus years. Now, what is PwC? It's a big four accounting firm. It's the largest accounting. It's among the four largest accounting firms in the world. And these companies, big four accounting firms, perform due diligence on public companies. So they analyze financial statements of big billion-dollar groups. So this little, multi-million dollar deal is nothing for him to analyze. It's very straightforward. So he looked at the deal and I said, the profit on the financial statement, we can just pay 3 to 5 times and we can acquire this company. He was like, whoa, hold on. On what profit are you going to apply the 3 to 5 times? I said, this profit, $2 million. We can put 3 times multiple and that's the value of the company, or 5 times multiple, that's the value of the company. He said, but how do you know the company is going to generate $2 million? I said, well, it has been doing so. And then he said, well, now the ownership is going to change, right? He says, yes. And then I said, yes, ownership is going to change, but the business should still produce, right? He says, it depends. What is the role of the owner? Is he going to continue? And then I said, no, he's going to retire. Okay. Then how much of the revenue he's bringing right now? And I said, maybe 60 to 70%. So he said, if the owner is not going to be involved as a doctor, 60 to 70% of the revenue may drop. And I was like, oh, I never thought about that. That the value of the, and then he told me that you're not buying the past of the business, you're buying the future of the business. And the variables in the business will change once you acquire the company. So you have to account for what those variables are that would change, and then you have to adjust the profit. If it's 2 million, you have to maybe make it 1.5 or 1 million, depending on what the fluctuation is, and then apply the multiple. But in my mind, it was 3 to 5 times profit, and all I have to do is apply the 3 to 5 on this profit that I see on the financial statement. And that just blew my mind, because the value of the company could be 3 million or 5 million, depending on what the profit that we assume to put that multiple. So just that minor fluctuation will have, a big effect. And then he started to ask me, all kinds of questions. What's the receivable cycle, etc., etc. And what a receivable cycle is they could have $1 million in revenue, but they may not have collected that cash. So they've performed services worth $1 million, and the patients owe them money. They haven't paid it yet, or they haven't collected from the insurance company. So on paper, it may say $1 million in revenue, but they don't have the $1 million in the bank. They have to still receive the money. So somebody owes you $20,000. You can actually report in your books $20,000 revenue, but you haven't received the cash. They just owe you. They may or may not pay back. So just because it says $1 million on financial statement doesn't mean they have $1 million in the bank. They may have it or they may not have it. And you have to look at the bank statements and various other documents to reroute what the truth of the company is. And another thing the owner started to tell me was that we can start, reducing the electricity bill, and we can reduce the electricity bill, and all of that gets added to the profit because we are reducing expenses. And then the PwC partner said, we can't do that. Electricity is an essential expense. We can't reduce that expense. And of course, he wants to reduce expenses and add to the profit because he's going to get a multiple of that. And I was like, holy shit, I never thought about that. And he was like, yeah. So he started to share his experience, and then he said, Prithvi, nobody can fool me when it comes to financial statements. I do this. This is my bread and butter. I know exactly what the owner is telling you. and I know exactly what he's trying to hide, and I know exactly the tricks he's going to play. So there is no algorithm to replace experience. So he's got tremendous amount of experience, and he can just see things in the financial statements that you may not be able to see, or it may not be clearly visible. He was seeing things that were not even there on the financial statements. He was seeing way into the future. So, and then he calculated how many surgeries does he perform and how that relates to the revenue, who are their clients, and all types of variables he analyzed. And if I were to acquire that company, I would just, by myself, I would miss all of those details. And that's just one point of view that you can have. You know, there is operations also, there is legal also. Another example would be operations, where one of my healthcare directors told me that, Prithvi, we need to be a little bit careful about malpractice. You know, some clinics are doing bad business. You know, they are buying maybe cheap Botox, or they're doing unethical practices, or if somebody's running a medical lab, they're just making up the reports and actually fluctuating somebody's blood samples, so that blood reports, so that they can prescribe the medicines. And he told me that be careful with malpractice. And then I was sitting with a plastic surgeon later on in a negotiation, and he showed me a picture of somebody, a patient, who had gone to a bad clinic, and they injected a Botox, and the Botox blew up in her face, and it had like swollen up really bad, and that patient came to him to fix it. And that's a result of cheap Botox, which is, could be considered malpractice, obviously. So you have these situations that I don't understand how, if you go by yourself, you'll be able to see it by looking at a company, unless you have experience. And this is why you need experience. Another example that another senior partner of PwC found out in one company was that they had not paid VAT taxes. So they were collecting some money in cash, not in the bank account, and they had paid VAT based on the money they received in the bank electronically, not in what they were receiving in cash. And there was an unreported revenues, unrecognized revenues. And this company, if we acquire this company, the government can say, what happened to all of the VAT liabilities that you were supposed to pay on this cash? And all of that VAT liabilities could come on us after we acquire. So there is a thing called undisclosed liabilities, that, there are things that the owner is not telling you. For example, they may not have paid tax the last 2 years, and now the tax is going to come on the third year, due on the third year. And that tax liability is on the name of the company, not the owner. So if you're acquiring the company, that tax liability is going to be on you. If you have that tax liability, the profit is going to reduce. But you paid 3 to 5 on this profit, not on this profit. So you have to identify what the liabilities are, and you have to reduce that and factor that in to the profit, because you're buying the future of the business, not the past. So these are just, some of the examples that I found in, showing deals to board members and getting their perspective. And then there was one time, the seller wasn't signing an agreement because it was too complex and it was too legally sophisticated, and he didn't understand what the deal was, and was prepared by a bad board member, who had to resign. And then I gave this agreement to a good, top lawyer who had advised on a $13 billion bank merger. I showed it to him, and he said, nobody's going to sign on this, Prithvi. And I said, why is that? And he said, because it's too technical for a normal seller to understand. And he was among the top 5 law firms in the world, and he was one of the top lawyers in UAE, one of the extremely respected lawyers. And he was telling me not to use technical legal language in agreements. And I said, why is that? I thought, it's a good thing and it has many interpretations. He says, no, it's not a good thing. When two parties understand what the deal is and you write it in simple words, it it's less likely to end up in the court. And even if it ends up in the court, you can easily reach a conclusion because things were clear and it didn't have multiple interpretations. So I was like, wow, I never thought that, because I thought legal agreements are supposed to be complicated and you're supposed to confuse people. But that's not the case. And I myself felt a little bit uncomfortable sharing it, but I didn't understand about anything about legal agreements. But this gentleman, who was in his 60s, has 30 plus years of experience in big deals. He said, simple language, 1.5 to 2 pages, he should be able to understand, and you should preface it with a letter. And then I was like, a letter? I mean, it's like this is not a romantic partner. I mean, this is an acquisition. He said, yes, but you write a letter. And I was like, okay. And then he drafted a beautiful letter. Guess what happened? The guy signed the LOI. So that's just an example where the board members, when they stepped up, there was a whole different dynamic that happened. Another example. So this was a meeting with a public company who owned, this was an Indian public company who owned a healthcare group in UAE, and I managed to get a meeting with them. And if I went there on my own with their CEO and CFO, I mean, it won't be enough. So I took my chairman, who was a $3.5 billion company CEO. I took my CFO, and I was received completely different. The credibility that we established in the meeting was off the charts. I mean, I had a lot of authority, I had a lot of command on the meeting, and that happened because of the board members. Another example was when I found a deal. It was a $10 million deal, and I was looking for financing, looking for debt with a bank. And I invited the banker at Four Seasons Hotel with a lawyer and another senior partner from PwC. And I could see the bankers were themselves, on the back foot, and they were appeasing us, and they were a little bit scared because of the board members that I had. They could not fool me. And bankers can make you sign documents that you don't want to sign. So you have to be careful with bankers. So because these people were there, the bankers were not able to pull out any trick that they usually would have pulled out if there was somebody non-experienced. So there's a credibility and experience factor that comes into play. Another example is I met another public company which was worth in the billions of dollars, and they had some trouble. They wanted to sell 2 of their assets, $100 million each. I myself would not have been able to set up that meeting, if I was a one-man show. I would not have even gotten an access to that meeting. But because I had these big players associated with me, it was very easy for me to get the meeting through somebody who was performing an audit on them. And that person I met when I was interviewing board members. And I didn't end up doing a business partnership with him, but he understood the project. He knew me. We had gotten introduced. And he reached out to me saying, I can connect you with this public company. Are you interested? They're looking to sell some assets. And I got that meeting through him. The reason he introduced me is because he also knew who is on the board. So there is a big credibility factor that comes with building a board that you can't get on your own. So yes, you can, you're going to speed up and do a deal, but you may do a bad deal. You may acquire a business that have undisclosed liabilities that you find out later on. If you're not able to pay off the debt, your credit, your reputation gets affected. Another thing that you want to be able to do is for the board members to be able to project into the future and anticipate the challenges that can happen in the business and account for that now. Like for example, one time, one of the lawyers proposed that the owner that we are buying the business from gets a life insurance on his name, and the amount of that insurance has to be the same as the debt amount, because most of the revenue is dependent on this owner. And if he were to pass away during this time, a health insurance would get triggered which would allow us to pay off the loan. So that was a crazy thing that I never heard about, and that came from a lawyer. So board members are invaluable. What you'll gain from them is going to be tremendous, and this is not about making a $5,000-$10,000 deals. This is about making millions of dollars in deal. And when you have something which is worth $1 million or above, or 5 million or 10 million, that's a complex ecosystem. You're not buying a real estate property, you're buying a business which has employees, which has licenses, which has tax liabilities, and complex structures in some cases, and various complex partnership structures also. In one case, about the $10 million deal, one of my healthcare industry expert knew that company and said they have legal problems. Talk to them when you're at the meeting, talk to them about the legal problems. And it turned out that they had legal problems, and we didn't pursue that transaction. So you have to understand, business can have challenges and problems, and you have to know them upfront. And you have to know what the cost is going to be, financial cost, to be able to deal with those problems. And then you have to take those costs and reduce that from the profit, or reduce that from the purchase price. You have to factor these variables. Dan Pena has a saying, investigate before you invest, and the more you investigate, the less you have to invest. Because the more you investigate, the more you understand that there are many layers of variables that you haven't accounted for. So that's the reason you need a dream team. You have to understand, when you buy a company, you are an outsider. You didn't create that company. You did not build that company from the ground up. So there are things that you're going to miss. So you want to make sure, and the seller is on the inside. So he understands everything inside, but you are looking at things from the outside. So you want eyes and ears that can look beneath the surface, that have experience in looking beneath the surface, and that have performed this activity of looking beneath the surface from a finance, legal, and operation standpoint as a part of their career. So that's an extremely important step. Everything is dependent on that. You have to understand you're raising capital from banks. You can't expose yourself, or can't do a bad deal. You're raising capital, you're somebody else's money. So when you're doing that, you have to be careful, and you have to structure deals properly. You have to be professional. This is not about speed, this is about quality. So that's another thing I see, is the whole thing has become about doing your first deal. This is not about doing your first deal. This is about building a portfolio of companies. You're not going to build wealth doing one deal, and you're not even going to have enough cash flow with one deal. So the idea is to do a series of transactions, a series of deals, perhaps 10, 15 deals. And for that, you need groundwork. You need contacts with the banks. You need law firm and accounting firm who can, perform the due diligence and stamp their branding seal that, yes, we have done the due diligence, so that the bank has confidence in you. When you go to meet banks, you can't go as a one-man show. You need a team, providing assurance that, we vouch for this deal, we have done the evaluation, and we have looked in and out, and we have structured things properly. Yes, it can take time, but it's going to reduce your risk, and it's going to increase the value and the odds of success dramatically if you have experienced people on your team. So this is about creating a portfolio, not about getting your first deal done, and then going to Bahamas or Bali. That's not what this is about. This is about creating a portfolio, and then creating wealth, because wealth is going to come from a portfolio, and you have to do a series of good deals to do that. And for that, you need the board members, and you need expertise how to integrate them from and how to do good deals. So that's extremely critical. So I want to encourage you to change your mindset to quality instead of speed. And you need the board members, and this is a common mistake, and people think, things have changed, times have changed. Dan Pena in his old age can't see how the world has changed. That's not true. He's very much up to date with what's going on, and Remember, do not skip the steps. You have to build the dream team, and you have to build the right dream team. So that's today's video. If you enjoyed, hit that subscribe button, and I'll talk to you soon.